Well, welcome back to Advanced Capital Group's series on investment planning. This is part 4, investment products, taxes, and next steps. My name is Matthew Coyle, and I'm the Director of Financial Planning here at ACG, and thanks for spending some time with us today. Well, this is a continuation of our series when it comes to investment planning. We have talked in the past about setting investment goals, understanding risk, investment types, and of course, investment products, taxes, and next steps. Today is, of course, investment products, taxes, and next steps, and we'll dive into the material. Well, as you would expect, there are a number of investment vehicles in which to invest your hard-earned dollars. Investments may be packed or categorized into many different types of vehicles. Here are a few examples of common investment products available in the retail market today. The first that we'll touch on are mutual funds. Mutual funds are pooled investment vehicles, a pooled investment strategy, if you want to call it that, diversified holdings that offer a high level of regulatory oversight. They are designed as baskets of securities that you may invest dollars in to achieve a certain asset allocation. Mutual funds have a designated manager or team of managers and are available by most brokerage accounts and through most investment managers. The next are separately managed accounts. This is an account in which you may buy a number of different types of vehicles, mutual funds or any others included. It is a personal managed account with a single investment manager and/or asset class, or a team of investment managers managing your account by itself to a specific strategy. Another variation of that is a unified managed account, or a UMA. A UMA might be an SMA with multiple investment managers and asset classes. A further refinement on this is a wrap account. A wrap account is a type of account that offers unlimited transactions, and the fees are wrapped into a single flat asset management charge. You may buy or sell a number of various securities, and it's all included within that one wrap fee. But everything in a wrap account is paid for through that single fee. Moving on to exchange-traded funds, or ETFs, these are similar to mutual funds with a pooled investment strategy or type of strategies, and they're purchased and sold continuously on exchanges like a stock or similar to some stock-like vehicles. An exchange-traded fund is similar to a mutual fund in its approach, offering a basket of securities on a tradable exchange. Rounding out the list, we have annuities. Annuities are offered by insurance companies. They are essentially insurance contracts that offer indexed, fixed, or variable payments. Some provide a level of benefit guarantee for a fee, and some do not. But in essence, an annuity is a stream of payments that you purchase from an insurance contract or insurance company for the purposes of achieving a given income over a specified period of time. Let's continue on with taxes. And as a reminder, your situation will be different. This is general advice only. For educational purposes, please consult your tax consultant if you have specific questions with your specific situation. Investing may provide you with some opportunities for favorable tax treatment. Let's start with capital gains and losses. Typically, capital investing is taxed at either short, which is 12 months or less, or long-term capital gains rates, which is of course over 12 months. Short-term capital gains occur on securities held for 1 year or less. These gains are taxed as ordinary income, and it's based on the individual's tax filing status and adjusted gross income. Long-term capital gains are usually taxed at a lower rate than regular income. The long-term capital gains rate is 20% in the highest tax bracket, and may incur some additional taxes based on your personal situation. Most taxpayers qualify for a 15% long-term capital gains rate, however, and taxpayers in the 10% and 15% tax brackets would pay a 0% long-term capital gains tax rate in many situations. In addition to capital gains, dividends may also receive preferable tax treatment based on your personal situation. Please see your tax advisor if you have questions about dividends, but just know that there are preferable tax rates available for dividend payments you receive from certain equity-based products. A particular note should be made for investment expenses in your accounts, which may in certain cases be deductible based on your situation as well. But again, see your tax advisor for this and other advice regarding deducting investment expenses. Now we move on to tax-exempt income or gains. Some investment or capital gains may be exempt from taxes. Examples of this might include 529 plans, for example, municipal bonds, and some insurance products. Future Wilson's models will cover this topic in more detail, so stay tuned. The takeaway for now is to learn how to make your investments more tax efficient by investing in specific vehicles. In addition to tax-exempt gains, you may also have tax-deferred gains. There are many types of savings vehicles that offer tax-deferred gains, like qualified retirement plans, 401ks, IRAs, and some insurance contracts in addition to that. Retirement planning modules we'll cover in other modules will of course focus on this as well. We should also touch on passive versus active income. Some investments as ordinary income or more favorable taxable capital gains depending on your role in the investment process. For example, most real estate and tradable securities are considered passive income and as such may have favorable capital gains treatment. By contrast, if you manage real estate investments and spend 750 hours a year to manage these investments, the income is likely active and as such is taxed at ordinary income tax rates. And finally, pre or before tax versus post or after tax rates of return. Certain qualified plans like 401ks, 403bs, IRAs, and other accounts offer pre-tax contributions and tax-deferred gains, leaving more money now for compounding. Post-tax or after-tax investments like brokerage accounts and savings accounts require payment of capital gains or ordinary income tax each year, making these a bit less tax favorable. Future modules will again address this topic in more detail. So let's cover some other investing principles. The first is diversification. Diversification is a risk management technique that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio constructed of various kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the single portfolio. Diversification strives to smooth out unsystemic risk events in a portfolio so the positive performance of some investments offsets or neutralizes the negative performance of others. Therefore, the benefits of diversification hold only if the securities in the portfolio are not perfectly correlated. Moving on, we have asset allocation. Asset allocation is one of the most important decisions for your investment portfolio, and it's the choice of asset allocation that makes that difference. Asset allocation simply means determining how much you should invest in each of a variety of asset categories, such as equities, cash, or cash alternatives, bond, real estate, foreign securities, and possibly even precious metals and collectibles if that's what you're looking to do. How you allocate your assets depends on several factors, including your investment objectives, attitudes towards risk and investing, desired return, age, income, tax bracket, time horizon, and even your belief in what the market will do in the near and long term. Let's say your investment objective is substantial asset growth. You have a 10 to 15 year time horizon, and you are willing to assume a high amount of risk. You might choose to place a larger percentage of your funds in stocks of newer, growing companies that may offer higher return but involve a greater degree of risk. In contrast, another investor with a 5-year time horizon, whose objective is preservation of principal and who doesn't want substantial risk, may invest more heavily in government or banking instruments. Your asset mix, the specific investments you choose within each asset category, and the timing of your investments all play a part in your overall return. Moving on to rebalancing. Rebalancing is a principal strategy within investments using allocation that is a process of realigning the weightings of a portfolio of assets, and rebalancing involves periodically buying or selling assets in a portfolio to maintain an original desired level of exposure or risk. For example, let's say an original target allocation was 50% stocks and 50% bonds. If the stocks performed very well during this period, it could have increased the stock weighting of the portfolio to 70%. The investor may then decide to sell some stock and buy bonds to get the portfolio back to the original target allocation of a 50-50 risk profile. Let's move on to dollar cost averaging. Dollar cost averaging is an investment technique of buying a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. The investor purchases more shares when prices are low and fewer shares when prices are high. The dollar cost technique does not guarantee that an investor will not lose money on investments. Rather, it is meant to allow investing over time rather than investing in a lump sum. This is how most investors invest. Active investing. Active investors, as the name implies, take a hand-on approach and requires that someone act in the role of portfolio manager. The goal of active money management is to beat the market's average return and take full advantage of short-term price fluctuations. It involves a much deeper analysis and the expertise to know when to pivot in or out of a particular holding, a particular stock, a particular bond, or any asset class for that matter. A portfolio manager usually oversees a team of analysts who look at qualitative and quantitative factors and then attempt to determine where to place their bets. Passive investing. Passive investing involves buying and selling within portfolios, making this a very, very cost-effective way to invest, particularly for retail investors. The strategy requires a buy and hold mentality. That means resisting the temptation to react or anticipate the stock market's every next move. The prime example of a passive approach is to buy an index fund that follows one of the major indices like the S&P 500, Dow Jones, or other type of index. Whenever these indices switch their constituents, the index funds that follow them automatically switch their holdings by selling the stock that is core or other funds that are non-core. Well, we will conclude today's relatively short slide with some takeaways and conclusions. So questions. What you need to find out as an investor yourself before you engage in this process is A, what is your risk tolerance? B, what type of investor you are? And C, what is your time horizon? Those are the most three important things when dealing with your investments, whether you're doing it yourself or engaging with someone else. General rules of thumb that I would want you to follow are, number one, know what type of investor you are. Do not take risk you cannot afford. And while investing does pose risk, you have a great chance to profit from it if your time horizon is appropriate. Leverage your online resources, ask around your local community for those who can help, or if necessary, engage with an investment professional who can assist you at a reasonable cost. Thank you. Well, as always, I'd like to thank you for your time today. My contact information is here if you'd like some follow-up notes or have questions on anything that we've covered today. This is a relatively short slide presentation. You can reach me at mcoyle@acgbiz.com. That's mcoyle@acgbiz.com. Thanks again for your time, and I do wish you the best of luck.